Evening, everybody. How are we tonight? Double thumbs up. Thanks, Jack. I appreciate that. That's like the most fun I've had all day. I'm so done with this. I got to tell you, like, I want you guys to just speak freely tonight because I am so done with COVID. I'm done with the coof. I'm done with mask wearing. I'm done with vaccinations. I'm just done with all of it. You know, everything I've had to go through this past week, and thank you for your understanding and condolences with the passing of my mother. So I appreciate that. But I'm just done. Like, it's time to get back to like where we were like a year and a half ago, 2 years ago, right? So tonight, we're going to kind of do some of it. We're going to talk about just the markets in general. Why do markets exist in the first place? Like, if we all just stopped researching and all the guys on Wall Street stopped doing their research and all the publicly traded companies stopped providing information to the general public, like, would we even have financial markets to begin with? And the answer is no, right? So the reason why financial markets exist is because there are opportunities for us as investors to capitalize on the information that exists in the public. Okay, so tonight we're going to get into 2 chapters from the course that I teach to the MBA students at Loyola. All right, so I'm kind of stepping away from the text that we're in our undergrad FI121, and tonight I'm going to get into 2 chapters in my MBA course that I teach that deals with the existence of the markets, why they exist, and how we can utilize the data that we have in front of us to find investments that fit into our own portfolio based upon our own willingness to take risk. Okay, because not everybody's the same. Bria has a different risk tolerance than Liam does. Jack has a different risk tolerance, than Kyle does. Okay, so tonight we're going to just kind of get into 2 chapters that will, if you take my course in grad school, all right, we'll spend a significant amount of time on, but nonetheless, with this being our final lecture for the semester, I felt it was really important just to give you some general context around investing and how to go about finding out what your own personal investment personality is and how that lines up with the options, not the futures options and other derivatives, but the choices that you have with where you're going to place your money when you invest in your 401k when you leave Loyola and get your job. So tonight we are joined by 10 folks in class at the moment. The chat room's open. All right. We have a number of our seniors. Congratulations. And I'm recording tonight's lecture for them. We have a number of our seniors tonight that are down at Camden Yards for a baseball game for just kind of, thank you, congratulations, well done, Loyola, move on to, the next 15, 20, 30, 40, 50 years of working in the real world. All right, so let's talk tonight. I'm going to go ahead and share my screen. And I'm going to go ahead and boot this up. So these chapters are from a different text. All right, but again, I'm recording it so you guys will have access to it, in the future. And as you study for, for the final, which we'll talk about towards the end of tonight. just let me get to this. Okay. Okay. All right. Can everybody see the just the main homepage for chapter 12? All good? Okay. So again, we're going to go through this chapter 12 and chapter 13 from the text that I use for my professional MBA students that I also teach. And what we're going to talk about initially is how do we go about calculating what the return on an investment is. And some of you may be going, oh my God, I know how to do that, like ending minus beginning divided by beginning. But in terms of investing in equities or companies that pay dividends, all right, it's not just as simple as taking your ending stock price minus your beginning stock price and dividing by your beginning stock price, right? That's just the capital gains portion of return on investment. But we also have to factor in if there's money that we get from these investments that we hold, so dividends, right? So we have to factor that into the equation to get to what we call total return, right? That's what we really care about, total return, not just capital gains return and not just dividend return. We care about the additive total return between those two components. And then we're going to kind of step back and we're just going to talk a little bit about history. Right? How have the markets performed over time? How have different asset classes within the markets performed over time? How do we utilize different asset classes to create diversification? Okay. And at your age, again, we talked about this at the very beginning of the semester. If you were to call a financial advisor right now, 99% of them would tell you, well, the first question they would ask you is, how old are you? Right? And you'd say, well, I'm 20 or I'm 21. And they'd say, well, you've got plenty of time. And so you should be 100% invested in equities, AKA stocks, right? Well, that's not necessarily comfortable to some people. Some people may not be okay to sleep well at night with being down 37% one year. That may create stress, even at the age of 23 or 24. Okay, so doesn't matter what your age is. It matters how you feel about your investing. So that's why we started off this semester talking about behavioral finance. Okay, your investment personality, how you feel about investing, how much risk you're willing to take. And so tonight we'll get into some parameters, okay, some risk portfolio metrics that you can look at to assess how much risk you're actually taking, right? So we're going to talk about history. Then we're going to talk about how does risk correlate to return, because as we've already said, you should be willing to take a certain level of risk that correlates to your willingness to take risk. And based upon that, you should be rewarded for a commensurate level of return for that risk you're willing to take. Okay, it's really simple. If you want to take a lot of risk, then by God, you ought to get a high return. If you want to take a balanced risk, then you ought to expect a balanced return. You can't have balanced risk and exceptional returns. It doesn't work that way. Okay. And then finally, we're going to talk about what we call efficient markets, the efficient market hypothesis, okay, which is a key factor in so many assumptions that financial analysts make in order to try to predict what's going to happen next. Okay. And as an investor, that's what we're trying to do, right? We only know what we know, and all of what we know is history. We don't know what's going to happen tomorrow. So there are three different forms of efficient market hypotheses. Okay. And we're going to talk about what those are, right? And then we're going to move into chapter 13, where we really talk about when you start thinking about investing on your own, what are some of the parameters that you need to look at? So when we think about risk, return, and putting the hard-earned money that we have made into the market, and we've talked about this, the stock market is a casino, right? There's no guarantees. It's putting your money into the stock market is literally no different than going to Vegas. Okay, other than the fact that over the last 12 months, we've been able to access the markets and we haven't actually been able to go to Vegas because of all the COVID protocols, right? But literally, like, putting your money in the stock market is no different than going to Vegas. There are casino games that come with more risk than other games that you can play in the casino, right? You can play a slot machine. You can play blackjack. You can play pie gow poker, right? They all come with different levels of risk. The stock market's the same way. You can put your money in bonds. And in bonds, you've got different segments of bonds, fixed income, right? You've got government treasuries, corporate bonds. You've got equities on the other side, individual companies that you could buy into, Apple, Netflix, Johnson & Johnson because of the COVID thing. You've got ETFs, exchange traded funds, baskets of companies that aren't managed by somebody. You got mutual funds that are managed by professionals that have, big old glass corner offices, and they drive Aston Martins and they charge you a lot of money to manage the funds. Okay. You have a lot of different options in the marketplace, and it's no different than a casino. And so if you're going to put your money into the markets, you need to understand what the risks are, what the returns are, what the probabilities of success are, okay? Probability of outcome. So the chat room's open, by the way, so hit the chat room. But how many of you have had a statistics class at Loyola? Just plop a thumbs up, type yes, type no, whatever. Just give me some idea of how many of you have had a statistics class, right? Okay, so Liam says yes, right? So when we talk about your statistics class, we're talking about standard deviation, okay? The probability of outcomes around a mean, an average, right? And there are certain games, there are certain sectors, there are certain broad sectors that will deliver a very consistent return on your investment. But that also comes with risk. Okay, so one of the things that we're going to talk about is there is a reward for bearing risk. If you're willing to roll the dice at the craps table, aka the market, okay, then you should expect to get the highest reward possible. But you should also expect on the other end of that conversation to lose everything. So if you want to double your money at the craps table, that's great if you roll a 7, right? But if you don't roll a 7, you can lose everything in one roll of the dice. Same thing with the markets. The markets come with risk. And in every portfolio, there's a place for those companies, those individual one-off companies, where you're just going to roll the dice. And you could double your money, you can go to 0. Right? But you've worked hard for that money. Right? So for the vast majority of your investments, it's not rolling the dice. It's building a portfolio of managed risk. Okay. And that's what we're going to talk about when we get into tonight. So when we talk about dollar returns. So in the very first lecture of our semester, we talked about biases, right? And we talked about confirmation bias, things that we hear that we then translate in our brains into something that could be positive or could be negative. So one of the things that I brought up was the market is up 300 points versus the market is up 1%, or the market is down 300 points versus the market is down 1%. Okay. If I use the dollar terms, okay, the market is up 300 points or down 300 points, we start to have much more of an emotional reaction to that, right, than if I convert that to a percentage term. If the market's down 1% or up 1%, it creates a very different emotion, right? But the reality of it is we do think about our investments in the form of total dollar returns, right? We like to know that we made $1,000 today, or we made $2,000 today. And so when we talk about total dollars, okay, it comes in the form of two components. It comes from, the income that we get from the investments that we make. So dividends, right? If we get paid a certain amount of money simply for owning shares of Apple, right? That's one component. We're making money simply because we own the shares, regardless of what the actual stock price does. And we also have an opportunity to make money based upon the appreciation of those shares that we own. So capital gains. We make money on the appreciation of the stock price going up, right? But not everything goes up all the time. Okay, so the total dollar return also factors in that potential capital loss, right? So we have money coming in the door from dividends, but the stock price of the securities that we own, it could go up and it can go down on any given day. And on any given day, we could choose to sell it at a loss or sell it for a gain, right? So the combination of the money that we earn from the dividends that we've received, plus either the additive capital gain or the subtractive capital loss, creates our total dollar return. Okay, so in this example, we buy a bond for $9.50. We've received 2 coupons of $30 each, and we can now sell this bond in the market for $9.75. What's the total dollar return? Well, part one, what did we get from owning this bond from an income standpoint? Well, we got 2 coupons of $30. So that's $60. So we had $60 coming in the door. All right. We received that just because we owned the bond. Right. And the value of our bond went from $9.50 to $9.75. So we had $25, right, of capital gains because the price of the bond moved up in the market. So between the $60 that we had coming in the door and the $25 that we had coming in from the price appreciation, at this point in time, we have $85 of total gain on the bond. Okay, that's our total dollar return. And what I hope that I've imparted on you is the best question that you can ask is, why? All right. Or conversely, what does $85 really mean in the terms of this investment? Okay. And so great. It's great that we made $85. We're positive, right? That's a good thing. We made money on our deal. But let's think about percentage returns. Okay. So $85 is great. Okay. But how does that translate into the percentage of return? Okay. So in many ways, like the first bullet says here, we need to start thinking more in terms of percentages, just like we talked about at the very beginning of the semester with the biases, right? the market's trading at like 32,000 for the Dow, right? I could say 300 points up or 300 points down, or it's 1.1% up or 1.1% down. Brings a very different emotional response to your investing. Right? So typically it's more intuitive to think in percentage terms rather than dollar returns. So when we get into this prior example, okay, and we translate the dollars that we were talking about into percentages, now we're talking about the dividend yield, okay, which is the percentage of dividends that we get, the interest rate, if you will, that we earn on owning that company, which is the dollars of dividends that we receive divided by the price that we paid for the stock. Capital gains yield, which is nothing more than your very basic percentage change, ending minus beginning divided by beginning, okay, gives you your percentage gain on your investment, the dollars of investment that you put in. And so we talk about total return, the combination of the dividend yield and the capital gains yield. And again, remember, capital gains yield can be positive or negative, right? Dividend yield will always be positive, right? Because you can't have negative dividend yield. If you had negative dividend yield, what would that mean? Anybody have an idea? If you had negative dividend yield, what would that mean? If you look at the formula there, the income that you get divided by beginning price, what would it mean if you had negative dividend yield?
One of those numbers would have to be negative, the income.
Be kind of like you had negative interest rates if you lived in Japan, where you had to pay you were paying the company whose stock you owed, you were paying that company to own their stock. Like you would be paying the company in addition to actually buying shares in their company, which is part of capital gains, right? Because capital gains is because you own the shares, right? Dividend yield, you already own the shares. So if you had negative dividend yield, it would mean that you engaged in a transaction where you were paying the company on some frequency to own the shares of that company. Okay, so dividend yield is always positive, right? It's a management decision of that company whether or not they pay dividends. Okay? So capital gains can either be positive or negative, because share price, beginning price, ending price can go up or down, right? You're locked in at the beginning price because that's where you bought it at. And from there on out, it can go up or down. So your capital gains yield can be either positive or negative. But your dividend yield can only be either zero or positive. So your total percentage return, your total return, which is what we call it, and this is something that a lot of investors don't understand. A lot of investors think that your return on investment is just what you make on the price you bought your stock for and the price you sold your stock for. Okay, you have to factor in the income that you also received as a result of owning that stock. Okay, so the total return on your investment is the combination of the dividend yield, the 1.8% that you might get from Apple, okay, and the capital gains return that you receive from owning that stock. So if Apple pays 1.8% dividend yield, okay, you're already 1.8% positive just from owning that stock. Okay? And if Apple moves up 10% in the market from a stock price perspective, right? Now you have 11.8% of total return on that investment for that period of time that you're looking at. Okay, so dividend yield plus the capital gains equals total return. Okay, two pieces put together. So we buy a stock for 35, we receive dividends of $1.25, and now the stock price is trading at 40 bucks in the market. Okay, so two components. Total dollar return, well, we've got $1.25 that we received in dividends, free money, free money. We owned shares of this company and they gave us money for owning the shares in the form of $1.25. Great. Part number one. We received, if we sold at $40, okay, if we realized these gains, we received $5, right? For the one share that we own. Okay, so 40 bucks minus 35 says for the one share that we owned, we got $5 of return. So from a total dollar standpoint, we got $6.25, $1.25 from the dividends and $5 from the actual stock price appreciation. Okay, so $6.25, fantastic. Okay. But does that really tell us anything? Is that good or is that bad? That's one thing I want you to take away from this class. Is $6.25 good or is it bad? Is it commensurate with the level of risk that we were taking on this investment? And the answer is, we don't know yet. Okay, so $6.25 in dollars. Now let's think about it in percentage terms. Okay, dividend yield. We bought the stock at $35. We received $1.25 of free money on that $35 investment. So the return on that investment from a dividend standpoint is 3.57%. So we received in dividend terms, only dividends right now, we got a 3.57% return simply from owning the share, the single share. Okay. And then we look at the price appreciation of the stock. It moved from 40 to 35. So we have a $5 gain on an initial purchase of $35, which is a 14.3% return on the stock price appreciation. Two components, right? We got free money from owning that single share, and we also get appreciation in the stock price because the markets have pushed that stock up. The two come together. So now we have a 3.57% return from the dividend, and we have a 14.3% return from the capital gains, which gives us a total return of 17.9%. Okay. Now, is 17.9%, is that good? Hit the chat room. Is 17.9%, is that a good return? Jack says yes. Liam says, I'd take it. I'd take it too. Okay. All right. The reality is you can't answer that question just yet. Okay, because we haven't gotten to the next part of the conversation around you don't know the level of risk. Exactly. That's right, Jack. Okay, way to go. All right, A+. Right? You don't know how much risk you're taking. Okay, you don't know if a 17.86% return is commensurate with the level of risk that you're taking. Okay. In the next 15 to 20 minutes, we'll get into a conversation around like standard deviation, okay, variance, kurtosis, something called skewness. If you've had stats before, you might have heard all that, right? But it's the breadth of distribution of returns around a particular mean. So if 17.86 is your mean, right? What is the probability of a certain percentage of outcomes around the 17.86%? Okay, so we can use the averages. These are great. It's important. 17.86 sounds awesome. Okay. But if our standard deviation is exceptionally large compared to other companies that will deliver a 17.86% return, then it's not commensurate with the level of risk that we're taking. Okay, so why do we even have financial markets? Right, this is an important thing. So we have the stock markets, we have the US markets, we have the UK markets, we have the European markets, we have the Asian markets, we have so many different markets that we can all trade on, and we can trade 24 hours a day, 7 days a week. Okay. Why do they even exist to begin with? Okay. Well, it's really simple. They exist because in America, capitalism is important. Okay. We enjoy being able to make something out of nothing and turn it into something that is profitable and contributes back to society and provides an engine of economy for a vast number of people. Okay, so it allows companies, governments, individuals to increase their utility, aka wealth. All right, what is the whole point, all right, of a financial manager, right, of a CFO, of a CEO, of a publicly traded company, of a privately traded company for that matter? The final point, the end game, right, is maximize shareholder wealth. Okay. It doesn't matter what industry you're in, what business you're in, if you're philanthropic or whether you're in the energy world or whether you're in the financial industry. We all have the goal of maximizing shareholder wealth. Okay. And when we think about our personal lives, who's the shareholder that we care about? Chat room. Yes, Jack, that's right. I see you. That's right. Who's the shareholder that we care about? Bria, Courtney, Chris. Who's the shareholder that we care about? Why are you even bothering to spend $65,000 a year to go to Loyola, Courtney? Or Solomon? Why are you bothering? Or Kyle?
It's an investment for future career potential.
Oh, Kyle's on. Oh, Kyle's got a green ribbon.
Did you hear that? Or you need to say it again?
All right. Liam, why are you even bothering to spend the money?
It's an investment for the future, I guess, is the way to put it.
All right, you're muted. I can't hear you.
Can you hear me now?
Oh.
Jack, can you hear me?
There we go.
Yeah, I can hear you.
There we go. There we
Kyle
go.
was talking to before.
There we go. All right.
Yeah. I think what Kyle said, what I'll reiterate, is kind of just an investment for the future based off of our education. We believe that Loyola can give us an education that will return the profit later.
Right. You want to make money, right? Like you want to make money. Let's not beat around the bush. Okay. Like You're going to Loyola and spending $65,000 a year to go there because it will afford you the best opportunity to make money. And if you make money, then you have the best opportunity to provide for yourself and, if you so choose, your future family. Okay, so the financial markets provide us with a lot of data, okay, about the returns that are needed for the various levels of risk that we want to take. Okay. I apologize, Kyle. I think I had my, I think I actually had my computer muted on my side, buddy. I apologize for that. So when we think about like the history, and same with you, Courtney, I think you popped in too, I apologize. So when we look back at like the history of the markets, okay, and this goes back from, you know, the early 1920s up until like the mid 2015s. And we look at the various asset classes within the market, okay? We got a few different lines here. And we're starting with like, what would a $1 investment have looked like if we had put that money into the market back in 1925 compared to how it would have grown to, you know, mid 2015, okay? And we see that the largest percentage growth, the largest total dollar, total percentage return, right, sits within small company stocks. So I want you to keep all of this in mind as we kind of progress through the next couple of slides, okay, because it all begins to relate to each other and it all comes together when we talk about risk. So we see the return, right? We invested $1 in 1925 in small cap companies. And if we had held it to mid 2015, we would have, that $1 would have grown to just over $33,000, okay? The next best performing asset class were large company stocks. Okay, now we're talking about things like Microsoft's, the Apples, the Netflixes, you know, that Tesla might actually now be considered a large company stock based on their market cap, okay? But so we're talking about those kinds of companies in the context of today. If we'd invested $1 back in 1925 in the large cap asset class, it would have grown to $6,000. So it's a pretty damn big difference, right, between the highest performing small company stock at 33,000 and the second best at 6,000, right? I mean, you're talking about, you know, a 5x return just by investing in small company versus large company, right? 6,000 versus 33,000, maybe 7x, okay? Between 5 and 6x. And then you've got down here, right? The worst performing, okay, I don't want to, I say worst, right? Because they are the worst performing, but we'll talk about why Treasury bills and long-term government bonds are an important part of a well-diversified portfolio, okay? So inflation, if all you did was buy inflation, your $1 turned into $13.50, all right? But it was pretty dang consistent. If you bought Treasury bills, all right, the most, well, it was debatable, but it still remains, all right, the most secure investment that you could possibly get into, right? US Treasury bills, okay? Your $1 would have gone to $20.62 over that 1925 to mid 2015 time. Okay? You still made money, but you didn't make nearly as much as the large cap and the small cap, right? So what I hope right now is what Jack said in the chat room. How much risk were you willing to take, right? and you think back to that first lecture that we had on the emotion that we have around investing. Okay. If you had the age that you're at right now, and you said, oh my God, like I've got time, I can ride it out. Okay. And all of a sudden, the Great Depression hits, right? And you would put all of your money in small cap companies, the green line, right? Okay. But because you had so much time, you said, I want the highest growth and the highest risk. So you put all your money into small cap. Emotionally, would you have been able to handle this right here? Would you have been emotionally capable of saying, my return on investment is down 80%, but I have enough faith in the markets that I'm going to ride this out to get to this point? That's a tough question. And quite frankly, I don't think I would have. I don't think that even as someone in this industry, a professional who deals with clients every day about this stuff, I don't think that I would have had enough like emotional fortitude to ride that out. Okay. So diversification. So these are the returns, right? $1 invested in 1925, and here are the returns, right? Over that period of time from 1925 to 2015. Okay. The question is, can you handle this? Can you handle this? Okay. From an emotional standpoint, are you capable of saying, I believe enough in the financial markets that if I'm in this section right here, that I believe that this is going to happen next? Okay, it's a question you have to ask. So when we look at these asset classes, right, we got large stocks, average return 12%, small stocks 16.6%, long-term corporates, long-term government, US treasuries, and inflation. Okay, so what we really want to like measure ourselves against is something that we can invest in, and we really can't invest in inflation, right? There's really not an investment that is specifically 100% tied to like the inflationary aspects of the economy. So the next best thing that we could consider to be like risk-free, right, is the US Treasury Bills, okay, at 3.4%. So if you were just going to take your money and not put it into a savings account at a bank, and you wanted to invest it, and you wanted to invest it in a way that essentially carried zero risk, all right, you would choose to place it in the US T-bill. All right, we call that the risk-free rate of return at 3.4%. Okay, so we've got this risk-free rate of return at 3.4%. All right, and then everything else, every other asset class above that comes with additional risk. Larger standard deviation. Okay, standard deviation is a measure of risk. Okay, so if we invest in T-bills, we're essentially taking zero risk, risk-free rate of return. And every other asset class or investment that carries more risk than the T-bill should deliver a higher return. Risk-return profile. And we see that. Government bonds, corporate bonds, small stocks, large stocks, they all deliver a higher return than our risk-free rate of return. And so we talk about risk premiums. And risk premiums are that extra return that we get for taking additional risk. Okay, the T-bills are considered to be risk-free. It is the measurement within which that all financial analysts like assess risk, right, against the T-bill, right? So the risk premium is the return over and above the risk-free rate, or over and above the projected Treasury bill rate of return. So when we look at these different asset classes, okay, we can calculate risk premiums. Right? So the US Treasury bill has an average return of 3.4%, but there is no risk premium because we're talking about above and beyond, right? And so above and beyond gets assessed against the the T-bill. So for comparing a T-bill to a T-bill, there is no premium, right? But if we're assessing the small caps, right, there's a risk premium of 13.2, which is just the difference between the actual average return of the small stocks and the T-bill. So we have a risk premium of 13.2%. If we're willing to take additional risk above and beyond the US Treasury bill by putting our money into small stocks, then the expectation is that we should earn, on average, over this period of time, an additional 13.2% above and beyond what the US T-bill returns us, okay? Incremental above that risk-free rate of return. This is a very important concept, okay? When we talk about things like the Sharpe ratio, all right? The ability of an investment to deliver above and beyond that risk-free rate of return, this is what we're talking about. Okay, so everything kind of gets measured against the returns of the Treasury bill because that's considered to be risk-free. So if we look at a frequency distribution of the returns in the stock market from that 1925 period through the 2016 time period, this is what we get. Okay, so we can see that we have the highest frequency, okay, of returns in this kind of 10 to 20% range, all right? Meaning that on average, we should expect to have the highest returns that will occur within this 10 to 20% frequency, right? And we have a distribution of frequency between 0 and 10, and also between 20 and 30. So we have another two sections. So another section of distributions of returns occur pretty significantly around this mean here between 10 and 20. So we have a large population, a large frequency of returns that are occurring between 0 and 30%. So if we look at the shape of the curve in totality, we can see like the Great Depression area, right? And we have the financial crisis of 2008, 2009, right? Okay. But we see the frequency of distributions with a mean somewhere in that 10 to 12% range, if we just look at the shape of the curve. Okay. So this tells us that if all we did was buy the S&P 500 ETF, then we should expect this type of distribution. Okay. From your statistics class, bet it on black, Liam. Yeah, there you go. From your statistics class, anybody remember about plus or minus standard deviations around the mean? Like what percentage of the outcomes are expected to occur around the mean? Okay. So we can look at the markets, we can look, like this is just large company stocks from 1926 to 2016, okay? You could do this for every single asset class or the S&P 500 or the Dow Jones, and you could look at the different distributions of returns, okay? And you'd get very different frequencies based upon the asset class that you're looking at. And what we care about here, even though this is just visual for the time being, What we care about is the distribution around the mean. How broad is this distribution? Like it could have started down here at minus 45, minus 50%, and the frequencies could have gone up from here and then cut over and then come down, right? So you could have had a very different shape to the distribution. So when we think about assessing or correlating returns to how much risk you're taking, right? It brings in the conversation of standard deviation and variance. Okay, so we're just going to move through the next couple of slides somewhat quickly because it's not important that you understand the actual calculations of this, more the concepts of variance and standard deviation. But when we think about variance, what we're talking about is, okay, what's the straight up like arithmetic average of all the returns, right? That's the arithmetic mean. And then we talk about the variance, which is the difference between each individual discrete year's return compared to that arithmetic mean. Okay. And then the variance is the sum of the squares of those differences. All right. And then the standard deviation is nothing more than the square root of the variance. Okay. So all that's great mathematically, and for those of you that are not in, the statistics or finance or, math world, don't worry about it. You're not going to be tested on any of this stuff, but it's important that you understand because standard deviation is important. Because when we look at the standard deviation, okay, it gives us an idea of the breadth of distribution of the possible outcomes around the arithmetic average. Okay, and when we look at the asset classes within the markets, and we look back to the slides prior about the large cap stocks, small cap stocks, where we got those highest returns, right? The small cap asset class, this guy, okay, gave us the most return, $33,000 of return on a $1 investment from 1925. But what we see in the distribution of the returns, okay, is that we would have had to accept a lot of years of negative returns and a lot of years of really positive returns in order to create that 50+ year average return of 16.6%. Risk, reward, correlation between the two. Okay. And when we think about things in percentage terms, right, we saw that the small cap stocks had an average return of 16.6 and the large cap stocks had an average return of 12. Okay. What's the percentage difference between large cap and small cap in this case?
4.6.
Think differently. Think in total return percentages. What's the percentage difference of return between large cap and small cap? If I said I have a portfolio that will return 12% and I have a portfolio that will return 16.6%, what difference in percentage terms is the small cap as it correlates to the large cap?
Does it depend upon the standard deviation?
Nope. No. What's 4.6 divided by 12?
%38%.
The small cap company stocks deliver 38% higher return than the large cap stocks do. Okay? You have to ask yourself these questions. Okay? The first response was it delivers 4.6 more percentage points, which is completely wrong, right? It delivers over 30% more return. That's a different subject. That's a different story. That's a different conversation, right? Okay. Small cap company stocks deliver over 35% more return than large cap company stocks do over the period of time between 1926 and 2016. Okay, that's the return. That's the reward, right? 35+% more return. How much more risk are you taking to get that higher return? So the standard deviation is the measure of risk. So tell me in percentage terms, how much more risk am I taking or you're taking in order to get the 35% higher return?
60%.
60%. 35% more reward, 60% higher risk. Ish. Okay. Are you willing to do that? Are you willing to make that trade? Are you willing to take 60+% more risk to only get the 30+% more return? The answer is probably no, right? If your only choice was to invest 100% of your money in one of those two options. So when we talk about diversification and we talk about portfolio design, there is most certainly a spot in your portfolio for small cap companies, right? They deliver great returns and it comes with a lot more risk, okay? But it's probably not wise to put 100% of your money in small cap stocks, which is why when we design portfolios, we're going to talk about this, we have a portion of your portfolio that is invested in small cap stocks to juice it a little bit, to get that extra reward, to take that little bit of extra risk, okay? To create what we call alpha in the portfolio, right? And we balance that risk out with these other asset classes, okay? To create a portfolio. So we talked about frequency distribution, right? The distribution of returns, right? Around the mean. And we can see that certainly the small cap asset class has a very broad distribution of returns. Okay. But we look at Treasury bills, right? And well, it's pretty well confined. Okay, right? So for those of you that have had stats, we talk about kurtosis, okay? Which is simply nothing more than, you know, the breadth of distribution around the mean, right? So we have kurtosis, okay, here, tight kurtosis, because the distribution around the mean is very tight. We have, you know, as Austin Powers would say in all of his movies, it's very tight. It's very tight. Okay, it's a very tight distribution around the mean. Okay. All right. But when we get into things like small cap stocks, we have a much broader distribution. Okay. So we have a broad kurtosis around the mean. Okay. So this becomes very important when you're designing your portfolio for your 401k, when you start putting money away from the money that you've earned from the job that you've had and the hard work that you've put in. Okay. And how it fits with the level of risk that you're willing to take. So, you know, what's very important, like some of the assumptions that we have to make in tonight's conversation revolve around the fact that we're dealing with a normal distribution, okay, a Gaussian type distribution, a bell-shaped distribution. Okay, so when we think about a Gaussian distribution and we talk about the mean, so we talk about large cap stocks have a mean, an arithmetic average of 12%, right? Okay, and if we think about a normal distribution, meaning that large cap company stocks have that kind of nicely bell-shaped distribution, okay, then if we calculate that standard deviation and we're plus or minus one standard deviation around that arithmetic mean, that arithmetic average that everyone's familiar with, okay, then we can say that roughly 68% of all the possible outcomes, of all the possible averages, of all the possible returns that will occur are going to occur within the mean of 12% plus or minus, okay, one standard deviation around that. Okay, so in the example of large cap stocks like this is, 68% of the probable returns that you would expect to receive are going to occur between, being down 8% and being up 32%. That's not too bad. I mean, that seems like a pretty good deal. If I'm putting my money in the market, like, okay, so 68% of the time, I'm going to be somewhere between down 8 and up 32. Like that's a pretty good trajectory, right? And if I stretch it out even further to 2 standard deviations, 95% of the possible outcomes, the probable outcomes, okay, based upon history, and everyone likes to think they can predict the future based upon history, and we'll talk about that a little bit later. But 95% of the probable outcomes are going to be down 28% or up 52%. That's still pretty good, especially when we go back and we look at the frequency distribution, right, of the large cap stocks, right? So we said this, the 2 standard deviations was minus 28 and up 52, right? So minus 28 is here, okay? Up 52 is in here. So I'm already 95% probable, right, that I'm going to fall somewhere already in the vast majority of the returns of large company stocks from 1926 to 2016. I've already shown that we're going to fall somewhere in here 95% of the time. The question becomes, are you willing to take this much risk? Okay. Are you willing to allow your portfolio to fluctuate across this frequency distribution of returns? How comfortable are you at night when you put your head on your pillow that tomorrow you could be down here? Or are you the forever optimist that your returns are always going to be up in the +2 standard deviation range? Okay. This is why we have these other asset classes. These asset classes, the government bonds, the fixed income, the Treasury bills, okay, the corporate bonds, allow us to build a portfolio that tightens the distribution around the mean, that gives us a higher probability of achieving consistent returns every year, which is what we want. In reality, like, we don't want all this crap. Like, we don't want to have to deal with being down 50% one year and then being up 50% the next year. Because quite frankly, being in this industry, that's really stressful. That's really stressful. I like this. I like inflation. Not from an investment standpoint, but from a graphical standpoint. I like being able to design portfolios that deliver this profile to my clients, where they can pretty much be guaranteed that they're going to get 95% of their returns around this particular mean. And I don't mean the mean of 3%, but maybe like 7 to 8%. Okay. I like designing portfolios that look like this. But to do that, you do have to create a portfolio that combines all of these, because you need some juice. You got to get some juice from the small company stocks. You got to take the risk at some point. It's just the way it is. Okay, so when we talk about efficient markets, it's very important to note that when we speak about stock prices being in equilibrium, it means they're fairly priced. When you look at the price of Microsoft, that traded in the market today, there are buyers and there's sellers, and there's volume. Okay. And if there's a lot of volume, it means there's a lot of buyers and there's a lot of sellers. So if you've got a lot of buyers and you've got a lot of sellers and they're prices that are being transacted on, then that's a fair price, right? Because it has to be in balance. It has to be in equilibrium. Okay, so if you've got high volume stocks that are being traded, then the price that is reflected in the market is a price in equilibrium, right? It must be. So if that's true, and the prices that are reflective within the market are reflective of the price that the buyers are willing to buy at, and the sellers are willing to sell at, then that price must be in equilibrium. And therefore, you cannot earn abnormal / excess returns on that trade. This is very important. Abnormal / excess return does not mean that you can't make a profit in the market. Okay, it simply means that you can't capitalize on an inefficiency within the market to earn a return that is not commensurate with the level of risk you're willing to take. Okay, it means that the price is fairly reflected in the market. Right? So it doesn't mean you can't earn a positive return. It just means you can't earn a return in excess of what the equilibrium price would dictate for you. Man, it looks like we've only got 4 people on tonight. Is that it?
Yeah, I think someone left.
Dang, man. All right, well, they're missing out, bro. This is a good lecture tonight.
I'm enjoying it tonight. No worries.
All right, so that's fun. You guys get the benefit. I appreciate you being here. And I know a bunch of seniors had, their like trip to Camden Yards tonight, so no big deal.
Yeah, we are seniors.
I know. So why are you not at Camden Yards?
I have a presentation tomorrow.
Okay.
So I've been preparing for that all day.
All right. Well, you make note of this. In 15 years, and be like, I made a crap load of money on a trade I booked tomorrow based on my lecture from my professor tonight, and you can thank me later.
We hope.
So when we think about efficient markets, like this is important. Okay. So you have reality and you have efficient market hypothesis. So in this particular case, you could think about this like a pharmaceutical company. Okay. And as it relates to what we've all been through for the past year with COVID, like Pfizer, all right? Who I believe was the first pharma company to release the vaccine for the virus. If you believe fully in the efficient market hypothesis, okay, then so what we've got here is you got stock price on the y-axis and you've got days leading up to some announcement, right? So day 0 would be like the day that Pfizer announces that, okay, we've got a vaccine for the virus, okay? And we've got -8 days, so 8 days prior to leading up to that point. And then 8 days passed. So the efficient market hypothesis would say that the moment that all of the information related to this vaccine for Pfizer is released to the public, okay, then immediately there should be a step change in Pfizer's stock price from 140 to 180. Because at that moment, all of the information that is now new has been released to the public, and therefore the price of Pfizer should be reflective of all of that new information immediately. Okay, that's the efficient market hypothesis. But we know in reality that's not really what happens, right? There's some sort of like euphoria, all right, that exists, which will pump Pfizer's stock price above its efficient price, okay? And then it will tail off and begin to revert back to the efficient price, right? That's the euphoric reaction, like the overreaction. Everyone was super excited about Pfizer like coming out with a vaccine. And if you go back and you look at their stock price, it actually reflects a lot of this. But there's this juice of the price, and then it kind of trails back off until it balances back out. On the other side, there could be a delayed reaction, right? Like Pfizer could have come out with their vaccine and the public was, you know, a bit skeptical about being the version 1 test subjects of a vaccine that took less than 8 months to develop. And so like they didn't quite put all of that efficient market into the stock price, and it took time, a delayed reaction for that price to kind of come into play. Okay, so efficiency is more of a step change, right? If you believe in efficient markets, then like your first reaction is the stock price moves immediately to the next most efficient point and then flattens out. Now we know that's not the case because we've talked about emotional investing. Investors are emotional, and we buy and sell for various reasons based upon different information that we're provided, whether it's from the news or whether it's from our own personal lives. And quite frankly, over the last year, some people have been forced to sell simply because they needed money, because maybe they've been unemployed or they've had their salaries cut back or for whatever reason, right? So they've been forced into a situation where they had to be inefficient in their investing, which created an inefficiency in how the stock price of whatever Pfizer was traded in the market that day. Okay, so what makes the markets efficient? This is really simple. It's the 4 people that are on this call right now, this class, myself. If we stopped doing research, if we stopped caring, if we stopped paying attention, if we stopped putting money into the markets, if all of the people on Wall Street just simply stopped going, well, what does this new information mean for the future price of the stock? Then the markets would collapse. Okay? Because the markets exist because people like you and people like me and people like the folks up, you know, in New York continue to do research. We continue to care about what happens with these companies that are publicly traded. Okay, so if we stopped researching, right, the markets are not going to be as efficient. Now, that's not a bad thing, because there's a lot of companies out there that have built their entire business based upon inefficiencies. Okay, arbitrage. Right? When we find inefficiencies in a market, we can capitalize on them. Right? There's a large number of markets out there that are not highly traded, okay, that have a lot of inefficiency in them, that create a significant arbitrage opportunity, meaning that it takes some effort to match the buyer with the seller, but when you do, you make a pretty good profit on that transaction. So things like whiskey exchange traded funds, Scotch exchange traded funds, high valuable art exchange traded funds, weather options. Okay, you can trade the weather, for God's sake. You know, betting upon how many, you know, days are going to be over the temperature of 65 next month. You can actually do that, right? There's not a huge market for it, so you're going to pay a little bit of a premium to go play with that, but there's an opportunity to make abnormal profits, okay, because it's an inefficient market at that point, okay, because there's not a lot of people researching the whiskey market, right? There's not a lot of people out there going, who has the inventory of super expensive scotches? Okay. So you're going to have to pay to play. So there's a high transaction cost, but there's an opportunity to make abnormal returns in inefficient markets. So some common misconceptions. Efficient markets don't mean you can't make money, right? We just talked about that. It just means that the price that you're going to pay or sell at is fairly reflected based upon the numbers of buyers and sellers that are in the market. Okay. So it means that on average, you're going to earn a return that is commensurate with the level of risk you're willing to take. Okay. If you're faced with two different investment options, right? One has a higher level of risk than the other, and they both have the same standard deviation, which is the measure of risk, then you take the one that has the highest return, because you're taking the same level of risk and you're getting the higher return. Okay. If it's flipped and the highest level of return has the least amount of risk, you take that option. Okay. If they have the same return and option B has a higher standard deviation than option A, then you take option A. So risk return profile. Okay. So final bullet point here. The markets are efficient, but it doesn't protect you from being dumb. Okay. So we're all free to make whatever choices we want to make. But market efficiency doesn't protect us against ourselves. Okay. So if we don't diversify, if we don't think about things like return and standard deviation, then all we're doing is hurting ourselves. Okay. So there are three different forms of market efficiency. All right, and we're going to talk about that for the next 3 slides. All right, so when we think about what's called strong form efficient markets, okay, we're talking about prices of securities in the marketplace that are reflective of all information, and I mean everything, public information as well as private information. Okay, so if the market is in strong form efficiency, okay, then we as investors should not expect, okay, should not expect to earn excess returns regardless of any information that we possess, because everything we know about that particular investment, everyone knows, whether you're an insider with the company or whether you're simply, you know, an average investor like we are all here. Okay. So when we think about translating strong form efficiency to how the markets actually work, history has proven that the markets that we operate in on a day-to-day basis, right, are not strong form efficient. Okay. This implies that insiders in companies can't earn returns above and beyond what you and I would be able to return. Okay, and that's fairly true, right? The whole like insider trading, like if you get caught doing insider trading, like you go to jail for a real long period of time, right? And there's a lot of rules within the Securities and Exchange Commission, excuse me, that prevent insiders from transacting within certain windows around like their analyst earnings call with Wall Street. Okay, there are restrictions that you can't trade prior to or post your earnings call so that strong form efficient markets don't exist. And then we have semi-strong, all right, where the prices reflect publicly available information. Okay, so annual reports, 10Ks, 10Qs, news releases, press releases from companies, okay, are made public. All right. So if the market is in semi-strong form, all right, then we as investors, we shouldn't expect to earn abnormal returns on that public information, because that public information is already priced into the price of the stock that we're looking to buy. Okay, it's already known, and therefore the price that's being traded in the market matching the buyers with the sellers, that price in an efficient market reflects all of the information that we now know. Okay, so what does that mean? All right, so when we talk about fundamental analysis, right, we're talking about digging into the financial statements of the companies, and we're using things like return on investment and asset turnover ratios, financial ratio analysis. We're using those ratio analysis tools to try to predict whether or not we want to buy or sell the security that we're looking at. But with semi-strong form market theory, it says that fundamental analysis does us no good, right? We can't generate additional returns based upon fundamental analysis, right? Because the price that's in the market already reflects all of the stuff that's been done by the company, okay? So larger, more liquid stocks, you're talking about things like Microsoft that are traded in the 10 to hundreds of millions of shares a day on the buy and sell side, right? Those companies, right, the price that's reflective, you can't make abnormal returns on that, okay? And fundamental analysis isn't going to do you any good, okay? However, you might be able to use technical analysis to generate abnormal returns. Okay, which leads us into the weak form. So weak form efficient markets mean that the prices that are in the market are reflective of everything trend-wise, okay, trend-wise that have happened with the stock leading up to that point. Okay, so if you believe that the markets are weak form, then we as investors should not be able to return excess returns based on trading market information, okay? Implying that technical analysis, right? Things like Bollinger Bands or the MACD or the stochastics aren't going to help us make additional money, okay? However, using fundamental analysis might allow us to make abnormal returns, what we call positive alpha. So when we think about the actual markets, right, in those three forms that we just talked about, okay, strong, semi-strong, and weak, and we look at how the markets have actually performed over time, we can actually go back and we can look at and see that the markets are traditionally, typically, weak form efficient, okay? So it means that, you know, we can use math and we can use data to try to predict what's going to happen tomorrow, all right? But in reality, we have to look at the trajectory that the company has been moving on based upon fundamental analysis going into the future. Okay, all right, so let's talk about just a couple things here. And this says quiz, but it's just kind of some conversation, right? So when we think about those asset classes that we were reviewing at the beginning of the lecture, like which one had the highest return?
Small cap.
Small cap, right? And which one had the highest risk premium?
Small cap.
Small cap, all right? So we would say that we were receiving a return that was commensurate with the level of risk we were willing to take, right? Like we got the highest return and we took the highest level of risk, right? But when we looked at that in percentage terms, okay, when we translated it from, not just, 12% to 16.6%, but we looked at that from a 4.6 divided by 12, okay? We saw that like it was a nice return difference, right? 30 something plus percent. But when we looked at how much additional risk we were trying to take or were willing to take to get that extra return, it was like north of 60% more risk just to get an additional 30+% return. Okay, so the lesson here is don't just look at the numbers, think about it, come at it from a different perspective. Okay, come at it from a different viewpoint and say, okay, like I like the additional 35+% return, but I'm not sure I'm willing to take the additional 60+ risk to get that extra. Okay. All right. So we talked about capital market efficiency, and if you go, are you guys looking at going to get your MBA at some point in time? No. All right. Well, you might change your mind in the future, and if you do, like capital market efficiency becomes a kind of a key discussion point to how we get to the a portfolio risk metric called beta. Right? The level of systematic risk that exists within a particular investment as it compares to the broad market. Okay, but the market efficiency, those 3 slides, at some point you're just simply going to have to believe that the markets are efficient in order to get to the next step, which leads to something called the capital asset pricing model. Okay. And then the 3 forms of capital market efficiency: the weak form, the strong form, and the semi-strong. All right. So in terms of the final, okay, all in Dogecoin, Jack. I still can't find a dang GPU for my gaming computer that I built with my son. Like, we got everything. We literally have like the most epic gaming computer built, except for the one piece that we need to make it work. In terms of the final, okay, so the final is going to be in 2 parts, right? The first part will be comprised of things that we discussed leading up into the midterm. Okay, so budgeting, time value of money, breaking out your expenses into fixed and variable expenses, SMART goals. Okay, so that'll be kind of part 1. So the midterm is a great place to start for part 1. Right, because there'll be things that deal with the 1040. All right, determining what the adjustable gross income is for a family. Right? Taxes. Okay, so the midterm is a good thing to review. The second piece will be more reflective. I know that this post midterm, I had some family issues that were kind of unprecedented, even in my own personal life. So it'll be a little bit more reflective in nature on and more written in context. Okay, so it'll be more of a written assignment, reflecting upon the semester, reflecting upon this class, reflecting upon, how you will use the information that we've talked about to make positive choices when you think about your next job, your first job. Okay, so it'll be more reflective in nature, right? So you'll have more of a, 1 + 1 is 2 for the first part, and more of just kind of a reflection for the second piece. The exam will open, all right, next Tuesday, all right, and you'll have an entire week to get it done. Okay, so officially our, I'm going to just stop screen sharing because we don't need, I don't need screen share. Officially our exam was scheduled for like May the 11th, right? 6:30 to 9:30, 9:15. But I'm just going to open it next week. And then you'll have the entirety of the following week until probably like the Wednesday after what it would have normally been. So like a full week and a day to get everything done. Okay, does that seem fair?
Is it possible to make the first part optional at all? If like, say you have a decent average in the class, or is that not going to be the case? It's very fair. I respect I like it so far. So I'm okay with either or, but
That's fair. All right, I'll give that some thought. Okay.
yeah.
Just because we were already evaluated on that material already in the midterm. You know what I
Yep.
mean? But yeah, I agree. It's fair.
What, you don't want to do any more work, Jack? What are you talking about?
No, that's not a.
You said you were a senior. Are you tired of being in school?
That's
Yeah, a
what
little
you
bit.
texted me,
A
yeah.
little bit.
Isn't your final semester at college supposed to be the worst possible experience ever?
Yeah. So far.
Par for the course. Par for the course.
No, that's fair. And I think, for the most part, the whole class performed pretty well, through the midterm. So let me just give it some thought tonight, and I'll get back with the whole class tomorrow. But I'm okay with more of like the reflection for the final.
Do you have I don't want to say secret sauce, but what is like your general, if you had to make a portfolio for someone, just very generic, how would you kind of allocate stuff? Like when you have a client come in, what do you do? I know we talked all semester about, well, it depends on your level of risk and this and that. But if you were just a very generic person who's young like we are and could stand to bear really any risk, like how would you go if you were in our shoes?
So I usually, and this is like 50,000 foot level. Okay. So there's usually two questions that I try to get answers to, and the answers could come from like 30 questions that I ask. Okay. But in general, I'm trying to get the answer to two questions. A, how much money do you have? Okay. To invest, that you want to invest, not what's in your checking account, because as we've talked about, like you need that for your operating life, right? So how much money do you have to invest? And then the second question is, how much are you willing to lose? Okay, so Jack, if you said like, I've just got 10,000 bucks that's sitting over here in an account that I don't need to use to live every day. And my job covers all of my operating expenses, but I want to turn that $10,000 into something more. That answers the first question. Okay, you got $10,000, and I don't care if it's $10,000 or $100,000 or $1 million, right? That's it. You've got 10,000. What you have is what you have. Okay, which then will lead to a series of like 5 to 10 other questions, but ultimately getting to, Jack, if you've got $10,000 sitting in the account, how much are you willing to lose? Like, what's your, like, if like, how much are you willing to lose before you said, you know what, I need to back away from the market?
All of it.
Okay, so 10 grand, you'd be willing to go to zero, and you're like, I'm fine. Okay, so that brackets the conversation. That tells me, okay, you're high risk and high reward, right? And at that point, I am beginning to design the portfolio of, predominantly small cap growth, no mid cap. Mid cap is a waste of time from my perspective. Like, you either go small cap and large cap, or you go large cap and small cap. Mid cap is kind of this weird asset class that you're not really rewarded for the level of risk that you're taking. Like, you can be, but you can also not be. So I tend to kind of stay away from like that mid cap asset class, and I'll blend large cap with small cap to create the hybrid between the two. Okay, so if you think about, like, Morningstar does a really great job of translating risk reward into like a 9-box square. Okay, where on the horizontal, 3 boxes, you have the different asset classes: large cap, mid cap, small cap, right? And on the vertical 3 boxes, you've got growth, blend or core, and value. Okay, so you've got this sliding 9-box grid that you can move investments in between. Okay, and so if you're talking about like a growth oriented, so like the vertical Morningstar boxes on the right hand side of their box, you're talking about companies that are using all of their income to reinvest back in their business. So they're not paying dividends. Okay, so you're getting pure growth, which that's what you want. Like if you're a small cap growth oriented company, so lower right hand box of the Morningstar boxes, if you're investing in small cap growth, those companies, you want every dollar that they retain for themselves to get pumped back into their business to grow their business. Okay, high risk, high return. Okay, so if you say you've got $10,000 that you want to invest and you're willing to let it go to 0, that's the box you're in. Small cap growth.
And how would you blend that with a large cap? Like, would you go 70-30, 60-40? Like I actually hold the VBK, the Vanguard small cap. So I mean that's been doing pretty well. I hold like that, and I hold
it was up like 2% the other day when everything else was like flat at like 50 basis points or even less than that.
Yeah, I hold that, and I hold the triple QJ,
Yeah.
which has outperformed the triple Q by like, I was kind of shocked by it, but I was kind of curious to see what would your ratios be as far as the large cap to the small cap, or balancing some of this stuff out. Where would you go?
So it's hard for me to give you a straight answer to that, because I would have to look at the standard deviations of each of those holdings and the returns. Like I don't know all of those off the top of my head. I know VBK is good. I use VBK quite a bit in my client portfolios. IJR is another one. So it's another like a small cap ETF that is predominantly more of that core. So it's a nice blend between the growth and the value. So if you look at the value box, like the the vertical box on the Morningstar grid, okay, the value side, when you see value, you should immediately think dividends. Okay, so dividends create value, right? So you're creating value for your shareholder. You're creating that additional component to the total dollar return that we just talked about earlier, right? So the shareholders are getting something in return for owning shares of the company above and beyond just simply appreciation in the stock price. Okay, but the amount of dividends, the yield is much lower on the small cap, right? Because small cap companies, like, you don't want a high yield small cap company. You want them reinvesting their money back in their business so they can become a mid cap, so then they can become a large cap, right? So you want them to grow, you want them to move up the horizontal lines in the Morningstar grid, right? That's the whole goal. So there's this, and it's more of an art than a science, right? So there's no exact answer to your question, like what percentage would I say that you should put of that $10,000 you might have into small cap growth versus large cap value, okay? But if you were willing to just simply let $10,000 go to 0, like if that was your answer, like if I asked you that and you were a potential client of mine and you said, I've got 10 grand, I want it to go to 0, my research then focuses on small cap growth. And whether that is, an ETF, a basket of those companies, or whether it's an individual like biotech company that, might hit it big with this next cancer drug they've got coming out, it doesn't matter. It means that your 10 grand has the potential to go to 0. And I would not even think about putting any of that 10 grand into large cap.
Would you even pick any large cap stocks as an individual stock pick, or do you just kind of stick to the ETFs? Like I mean, I have a couple cruise lines. I have Delta, UPS did very well today, but I kind of have it split. Like I have like 50-50. I have 50% in some of these index funds and 50% in some of just straight up stock picks. Is that like, should I just be more into one than the other? Or I mean, I'm guessing it's more of a mental thing. Like I like picking stocks and you like to see, you know, what versus just an index. And I'm not sure if that's sort of a bias and it's not really worth bothering with. And I should just be in index funds, you know?
It's emotional,
It is.
right? Right. We as investors, whether we like it or not, like we feel more emotionally connected to the market if we buy UPS, right? Or we buy an Apple, or we buy shares of a company, right? We feel more connected to the markets when we do that, right? The unemotional side to investing says when we buy individual companies, we're opening ourselves up to more risk, right? Because the risk that a company like UPS has as a standalone business versus the risk that the global transportation ETF has, there's a significant difference in the level of risk that one has versus the other, right? I mean, the United States government could change regulatory policy on, you know, domestic transport and slap a 10% transportation tariff on all domestic goods that are transported, right? Which would like drastically impact UPS as a whole, but probably wouldn't impact DHL very much at all. Right? So there is a balance between like individuals owning individual stocks and owning baskets of sectors. Okay. And if you do go get your MBA and if you do come to Loyola, you'll take this class that we talked about tonight, and we get into that where we talk about the systematic risk and how we go about designing portfolios to balance the beta across different sectors in order to achieve a common goal. Because why do we invest? We invest to make money. We invest to grow our wealth, right? Like that's the goal. And quite frankly, I don't really care how we do it. Like, I don't really care, you know, if we're investing in oil companies or we're investing in cruise lines or we're investing in green energy. Like, if you believe in the markets for the purpose that they were designed for, your whole goal ought to just simply be to maximize your wealth that is commensurate with the level of risk you're willing to take. And I know that is frustrating to a lot of people, especially in this day and age, but like that's reality. That's the reason why the markets exist. So the answer to your question is kind of, it depends. You know, if you have $10,000, like you said, and you're willing to let it go to zero, then you ought to be investing in individual biotech companies in the small cap growth sector of the Morningstar box. Like that's it. That's all you should be doing. You know, or capitalizing on the news, like last year when the pandemic really started to set in, and in my business, you know, when the airlines started to shut down and the cruise lines started to shut down, I mean, I was buying United. I didn't buy American because they're way too much in debt, but United Airlines, Delta Airlines, Norwegian Cruise Lines, Royal Caribbean, like Hilton, Marriott. Anything that was immediately just like crushed because of the news, emotional investing, remember? The market that created an inefficiency that took their stock price to a point that was not efficient. And then you capitalize on it. Does that help? I know it wasn't an exact answer to your question, but there really isn't an exact answer.
Yeah, yeah. No, it did help a lot. And I do have one more question if anybody else has anything they want to say. I mean, it's the last class, so I thought I'd pick your brain.
Pick my brain, man.
So if you had some money saved up that you had in the market and you also had some student loan debt, like I'm a little risky, and I'm thinking that I kind of want to ride out this artificial recovery. But I'm also a little concerned about the printing of money. And I
Yep.
know that if I throw it at my student loans, I mean, that's like a guaranteed return of whatever my interest rate is. I know the interest rates, I think they're at 0 right now for the student loans.
Refinance your student loans and pay it off.
You would just go right at student loans. You wouldn't bother holding off.
Yep.
All right.
I mean, I get asked, so I have many of my clients have, kids that are your age, and they have loans, and I get asked this question multiple times a week. And my response is exactly what I would tell you. Refinance your loans, consolidate and refi. Right? Because if you think about the student loans that you've accumulated over your time at Loyola, right? They're in layers, right? And the only thing that's happened since your time in Loyola with interest rates is that interest rates have gone down since the time that you started at Loyola. So you took out a student loan, maybe your freshman year, right? The fall semester of your freshman year at a certain interest rate, and they come in layers, right? So you take out a loan in the fall, you take out a loan in the spring, you take out a loan in the summer, you take out a loan in the fall, and it goes, right? And each one of those loans has a different interest rate. And between the time that you started at Loyola and the time that you're at right now, rates have fallen to historic lows. And you're not quite yet at the point, and you've got 6 months after graduation before you have to start paying those loans back. So if rates are at the lowest point they've ever been, now is the time to consolidate all those loans and refi them at the lower rate, at the lowest rate. Because otherwise you're going to wind up paying a higher interest rate in aggregate, because rates have fallen over the time you've been at Loyola, right? So now's the time to refi and consolidate, and then pay that down. Okay, I would not, I mean, I don't know what's going to happen with this whole conversation in Washington around like forgiveness of student loan debt. And quite frankly, it just pisses me off. Like, I paid $35,000, $40,000 freaking dollars of my own money to pay off my own student debt. Like, am I going to get, reimbursed for all the student loan debt that I had, or.
Yeah, I mean, I don't want to graduate, pay it off, and then like 6 months later they start forgiving student loans. And
I know. See, that's the problem. Like, so that I agree. Like, that's the dilemma. But like, for one thing, consolidate and refinance is a good first step, because that brings everything down to like the market interest rates, right? That is a smart thing to do. And then just work to pay it off, man.
Yeah, I'd imagine that betting on Uncle Joe probably isn't that great of a bet. So
Oh, the child sniffer.
yeah, I like the tumbler. I like the tumbler on your desk.
What's that?
I like the
sorry. I never know. I apologize. I didn't realize the label was headed towards the camera. Well, if I had pointed it this way, maybe. Oh, there's the case of freedom. But nonetheless, so yeah, I would really look at that. And have you gone to talk to your financial aid office to like see what your like layers of loans look like and what interest rate each of the loans look like?
I know what my loans look like. They're all just the federal, so I think they're all the same interest rate.
Okay, cool. Yeah, but I mean, that's the direction I would go.
All right, thank you.
But again, like, that's just me. Like, I don't like debt. I don't like owing people money, and like, I'd rather get that cleared and then be able to, I don't want to rely on the possibility that Uncle Joe's gonna pay off my student loans. Anybody else? Liam, Chris, Kyle?
Well, you and I have already talked privately
Yeah.
about, because I'm going to grad school, so I'm
Yep.
trying to refinance in a way that's going to allow me to pay it off in a timely fashion without, going broke. So I still need to eat.
Exactly. I know. Well, I've got 3 kids that are, that within the next 5 to 6 years going to be what, the position you guys were in, 4 years ago with being a freshman in college, and I'm just trying not to go broke.
Tell them to get scholarships.
Well, yeah, they're all very intelligent, but none of them are going to be like soccer stars or anything like that. So what about you, Chris? How you doing, man?
I'm hanging in there. Like sports are doing okay, going to an end, but otherwise still trying to find a job, but otherwise just hanging in there. But I know because I know we were talking about last week in class, and also you were just talking about before, kind of with the emotions, going into investing. So how with COVID and everything, people are people are trying to buy out or trying to sell from being so high up, with the cruise lines and the airlines. Wouldn't you also say that some people are also because of last week with a lot of the stuff happening in the over in the White House and in the courts, would you say a lot of people were trying to invest into in pro Second Amendment activities as well, in purchasing in finance and stocks and bonds of firearms?
Man, I am finally somebody brings this up.
Well, I don't want, but for me, I'm always I always know within right now, it's always a little wary when it comes to those things now these days.
Why? That's the whole point of college, man. The whole, this is it's one of the things that sometimes I get my hand slapped on, right? But part of the point of college is we have to talk about subjects that might make some people uncomfortable a little bit, but talking about the Second Amendment doesn't make me uncomfortable at all. So yes, when we think about investing and we think about the very first class that we had, and we talk about the emotions that go into investing, right? And behavioral investing, behavioral finance, right? The biases that we have. You've got to strip all of that out. And I know that you can't do it right now because you're young and you haven't had the experiences that you're going to have, but you will have the experiences, right? And those experiences are going to create biases, and you already have them, but they're going to be more and more frequent, okay? But when it comes to investing, and unless, well, I don't want to say unless, but if you are in the investment world like I am, where I'm literally managing people's money, every single day, I have to be unemotional. I have to strip out emotion from recommendations that I make to clients. It is my job simply to provide them with information, to provide them with data, to provide them with research, and then allow them to make whatever choice they're going to make. Okay, so to your point, over the last 18 months, okay, so even prior to COVID, okay, the conversation around the Second Amendment and firearms and, the supply chain of ammunition, for example, right? The supply chain of ammunition. Forget whether or not you are a firearm supporter or not, and you think about it from an economic standpoint. Since COVID kind of locked everything down, and you look at the FBI background check data for the number of background checks that have occurred, they are off the charts compared to prior years in terms of people who are actually going out and purchasing, personal defense firearms. Okay, so you've got people who already own firearms. And then you've got this whole host of people who are new to the community that are purchasing firearms. And you've got the other people who have been in the community for a while buying additional firearms that might be regulated, right? And all of those need what to be effective? Ammunition. And so the supply chain from the primers to the raw materials to the brass to the steel to the full metal jacket, you know, the actual bullet itself, like it's been unbelievable in terms of an economic standpoint. So companies like Vista Outdoors, okay, Smith and Wesson, well, Vista owns Federal. What's the other big one? You know, CCI and Blazer Brass, right? There are so many companies that have been in that sector that if you had bought into them at the first part of last year, you'd have doubled or tripled your money. But now is probably a good time to take those gains because they just can't, they don't have the supply to produce what needs to be produced to meet the demand. Okay, so to your point, Chris, like, yeah, there's always an opportunity out there, regardless of what position you might like to take on the Second Amendment. If you're going to be an investor, you can't take party lines, right? You have to see black and white. You have to see just simply dollars and cents. That's it. That's the whole goal.
But then would you also say that like within the firearms industry, I'm pro Second Amendment, I have a whole bunch of myself, but would you also say that purchasing firearms will also be part of the asset as well? Like when filing down, like and putting into investments?
I mean, like owning an actual firearm as an investment, as a physical asset?
Yes, as a physical asset.
Well,
now with
since this is being recorded, I'll probably get my hand slapped tomorrow. But yes, I 100% agree with that. I've done that. Like I did that like this past year. Like I recognized that there was going to be a supply issue, but a very high demand situation. And so, like I would say the first part of last year, I purchased a number of items that for no other reason than just to resell them, period. And so, yeah, so thinking back to our lecture tonight, right, we talk about efficient markets and inefficient markets and finding that when you find that inefficiency, we call that arbitrage, okay? That's what that was last year. The markets fell completely out of whack for about 6 months. Okay. And so there was an inefficiency. And guess what? You know what? Like firearms compared to trading stocks, like stocks are so much more highly traded, right? Like it's so much more of a liquid market for trading stocks, right? Because you've got 1 billion plus shares that are traded on the market every day on the buy side and the sell side. But when you think about physical assets, it's a much less liquid market. And so you can take advantage of those inefficiencies to make profit. And so last year I got my FFL, my own personal like federal firearms license, and I was able to transact on those items that I knew were in that kind of inefficient arbitrage opportunity. So yeah, 100%. What else? Kyle's quiet. I think he ghosted us.
No, I'm scared
Oh,
here.
he's here.
I don't know. I got a couple things on my mind. at least first off, I'm planning on being a teacher, and I know that I guess finances are oftentimes a little bit strict in that line of work. So I was just curious as to maybe what would be some suggestions outside of like, I guess, having other work outside of being an educator, and then outside of investments, like I've kind of started to get my foot in the door a little bit with that sort of thing, investing in stocks, just looking at different types of things that I can invest in. But I guess maybe what you would recommend, should I just work like hell and hope for the best? Or should I try to put, I guess, a lot of my cards in different places and see how things go from there?
Kyle, my initial response is just do what you love, man.
Gotcha.
And everything else will kind of come from that. I mean, you know, I never started off thinking that I wanted to, you know, be a professor, right? Teach. And, you know, I went to Georgia Tech and I got a chemical engineering degree, for God's sake, and spent years building chemical plants around the world, and then moved into mergers and acquisitions, and, you know, then more, you know, deeper into finance. And then, you know, life happened and I started to have kids, and then divorce happened and I was a stay-at-home dad. And, you know, I think that you just have to, there just has to be something that is true to your core, no matter what you're doing, you know, with whatever job you've got. I mean, like we talked about at the beginning of the semester, you know, you're going to change jobs, companies, you know, 15 times probably in your career, you know, but hopefully every time you make that transition, you're making the transition because, you know, you're following your center. You know, you're not selling yourself out. You know, you're following your gut feeling, and you're following what keeps you, you know, getting up in the morning. You know, so whether so it doesn't matter whether you're investing in the markets, or, you know, you're a teacher who doesn't, you know, make a lot of money. Like, none, as long as you're following your center, like, to me, that's the most important thing. And that's what I would tell my kids.
All right, great. Thanks. I appreciate that. Also on a little bit more of a, I guess, a broad reaching note, I guess. I know the education system has been in need of some reform for a really long time. It doesn't seem like too much has changed in the past, 60, 70 years. So,
Yep.
I guess from your perspective as a professor, what advice would you be able to offer me if I would like to make like a much more large scale change in the education system?
Blockchain.
Blockchain?
Yep.
Okay.
I think blockchain technology will completely transform academia within the next 10 years. So like the backbone of like the cryptocurrency, like Bitcoin, like that decentralized ledger, I think has the potential to really transform academia, like within the next 10 years, where we move away from this idea that, you know, teenagers have to decide what singular university that they're going to go to, and then spend $65,000 a year going there, where only 25% of their classes are going to be actually meaningful when they graduate. And instead, they're able to, you know, pursue their passion, say whatever, education or biochem, or, you know, whatever, you know, finance or investment banking. And they're able to, you know, take courses at the best institutions across the country or across the globe, okay, and have those courses kind of hashed into their blockchain, so that then, and we don't have to get into the whole technology of blockchain, but it's a triple ledger decentralized system where it can't be hacked, and it is basically part of like your DNA. And so companies in the future can say, look, I want someone who, has these, A, B, C, D specific skills, and they'll be able to go out and search the blockchain for a collection of individuals who have those specific skills, not necessarily where they went to college, okay, but those skills, and they will be able to then, recruit from the blockchain. So that's kind of my thoughts on that.
I think that's interesting, but don't you think that would also cause the bubble to burst pretty much? Because you mentioned there's a bubble related to the higher education, and I agree with you in the sense that it's becoming extreme and eventually it's going to be something crazy. But I think that would have to happen, I guess, after the collapse. Or
So you mean like the collapse of the academic bubble?
yeah,
I totally think that the collapse of the academic bubble is coming.
because I agree with what you're saying. I think it would be more efficient for people to choose not just a school, because I understand people don't know what they want to do right out of high school, but it's
Yep.
I don't know. I just agree with you in that sense that it's pretty much like you're under a tutelage of specific professors in specific fields.
Yeah. I think that you're 100% right on that. Like you are under the tutelage of whatever professors happen to have gotten hired from the institution that you chose to go to. And as much as I like to think that I'm fairly okay with how I teach, I guarantee you that there is a whole host of other professors that will do my job so much better than I do. Like, I'm not arrogant enough to say that I'm the best of the best. I know that there are professors out there that will do a better job. And so if I think about my own children, wouldn't I want that? Like, wouldn't I want them to be able to find like the best of the best professor to like educate them for whatever subject matter that they were endeavoring on. And so I think there will always be a place for like academia as like we've all known it. But I definitely think that over the next 10 years, we are going to see a change in more of the like, I think it'll start with like the trade level, like trade schools, like the former, like the old school, like trade schools that used to exist that don't exist anymore. I think we're going to start to see more of a change in that over the next 5 to 6 years. And blockchain will help with that, because it's unbreakable. It's 100% verifiable. And quite frankly, there's a lot of companies that probably just want people who can specialize in very specific things. So anyway, that's Kyle, that's kind of my own personal thoughts on that.
No, that was fantastic. Thank you. I really appreciate it.
All right, guys, anything else for tonight? Or, again, just email me. Like, I'd love to get coffee with you guys if you have further questions, or you want to talk a little bit more, Jack, about the investing or, portfolio design, or, just in a little more depth about, the math around designing, portfolios. Happy to do that. And I really appreciate y'all's support and patience this semester.
Of course, and thank you for the semester. We don't have class next week, right? Next week.
No, that's it, man. You guys,
Yeah.
starting on Monday, you guys are on your study week.
Crazy.
Yeah, thank you.
Thank you so much, though, for the semester. I do appreciate everything.
You got it, Liam.
Me as well.
All right. Cheers, guys. See you, Chris. See you, Kyle.
Thanks,
And,
Professor. Take care.
reach out if you need anything. I'm here for you guys, even beyond the class. Okay.
Thank you.
Thank you.
Thank you.
Cheers, y'all.